Welcome back. In the previous chapter, we covered how you should choose your portfolio as an investor, given measures of risk and reward. In this video and chapter, we do something entirely different. We take the perspective of what would be expected to be an appropriate reward given risk, or some other measures of similarity among investment choices. This no longer depends just on you as an individual making a choice, but on a collection of millions of investors and millions of investment opportunities. Economists call this equilibrium. Let me give you an analogy for that. So, for example, I taught you by now how you should look at something like Car Trader and decide what car to buy. Now we're looking at, within Car Trader, how should the cars be priced relative to one another so that they all sell in reasonable time frames. Here, what would we reasonably expect stocks to offer in reward? Well, not in absolute terms, but in relative terms. How much more or less than other projects should a particular project offer? So, no difference in opinion, no taxes, no transaction costs, lots of competition, risk and risk aversion. But I'm not going to lean too heavily on my assumptions in this particular set of slides. The next slides I will have to. I am also shifting perspective. That is, before it was all about how you, as an individual investor, should pick your portfolio. Now I'm going to be the manager of a company trying to convince you to give me your money. So I'm going to have to attract your capital. I have to keep you as my investor in this company itself. So it's a completely different vantage point. For me to understand this, of course, I have to understand how you think, or else I will never be able to talk you into parting with your money and giving it to me. But before you give it to me, the first thing I need to think about is, am I the fiduciary and custodian of my investors' cash? If not, who should I serve? I'm going to presume that as an investor, I'm interested in your wealth, in your welfare. Now, this is a benevolent fiction. It isn't really true, but it's a working assumption. There are good reasons to do this. So this is our presumption. As a corporate manager, your task is usually to act on behalf of your investors. Since we are in a perfect capital market, you, my investor, know my objective. There's no asymmetric information. It's not that I know more than you do. You know what it is that I want to do. And you will give me your money because you believe, you know that my objective is to act in your behalf. There's also some fiduciary laws that says that if I don't do this, I could land in prison in extreme cases, or could be fired, or all sorts of other things could happen. But in this case, this is not a problem because we're in a perfect capital market. You only give me your money if you know that I'm going to treat it right. But how do I act on my investors' behalf? How do I act on your behalf? Well, here is the problem. Can I zoom my investor and ask? Well, in a publicly traded company, there are hundreds of thousands of investors. They're all different and diffuse. Most of them have very little investment in the company. I may run a $10 billion company, and the average investor has, I don't know, $1,000 invested in my company. They don't have the time to want to become informed. They don't want to be bothered. It's hard even to get them to vote online. Imagine you have another company meeting with thousands and thousands of people that are just listening to this and want to chime in. Nobody has this ability to aggregate this. So what I have to do as a manager, I have to figure out what your wishes are. I have to have reasonable assumptions about what it is that you want. Now, okay, what should I assume you want? Do I believe that you really truly care about my firm? Probably not. What you probably care about is how much money you make in my firm. Do you care about me and my family? About doing the honest thing? Probably not. To you, I'm probably just an anonymous manager. Do you, as my investors, care greatly about my employees, or our employees in this case, to the extent that you're willing to say, Here's my money. You can have my money. I pay you more than you deserve because I care about you. Probably not very much either. You probably put money into the company because what you want is the company to do well by you. Do you care about social welfare? Do you put money in there because you want to have the best for the whole United States or for the whole world? Well, there are some companies where that is the case. There is a company that packages food for what formerly was USAID, which basically sent food packets to Ethiopia and Sudan. There's a particular kind of investor that may be willing to accept lower rates of returns just because the firm really does a lot of good. But for most publicly traded companies, that's probably not the case. What they want is me, as their manager, to do the appropriate thing to maximize the wealth of the shareholders. You are the shareholders. You've entrusted me with your money. That's presumably what you want from me. If you want to give extra money to the employees or to social welfare, I could send up a fund and I could ask my shareholders, please send your money in there. It's special purpose only for giving extra bonuses to the employees. Be my guest. I'll be glad to hand that out. I can tell you there would be virtually no money flowing into those. Do you care about me as a company supporting abortion rights or objecting to abortion rights, to the right to life, to the right of choice? Which side? How would I as a manager know what you like? There's just no way that I can figure this one out. Do you care about politics? That is, you want me to pursue Republican policies or Democratic policies? I couldn't know this. I presume sometimes Republican policies are better and sometimes Democratic policies are better, but that depends on the business environment. It's not because you have a preference for politics. Do you care about pollution? Well, to a certain extent you do, but we could do this like with the social welfare. If you really care about this, give me an extra pot of money that's dedicated to fighting pollution. So, as a manager, it's not 100% clear of what my investors like or dislike. Presumably, all of them like a higher share price. If they care about other stuff, they can often do this elsewhere. So you care about pollution, there's great advice that I can give you how you can fight pollution. But trying to fight pollution by investing in, I don't know, General Motors or Northrop Grumman, it's really hard to imagine what I as a manager can do about pollution. So for the most part, we believe managers care about maximizing firm value to the extent that entails not blowing up your factory or being really pollutive. That's what I should do. Of course, I should care to pollution to the extent that it maximizes shareholder wealth. And you have companies that, like Dow Chemical, that many decades ago had a whole factory blow up in India that killed thousands of people. That is so completely unethical. It's horrendous. And I am not saying that that is something that Dow Chemical should have done, which is not to care about those people. Of course, they should have cared about those people, but they should have cared within the law, and they should have cared about doing this right, and they should have cared not to have huge liabilities. And if the managers themselves have any moral standard, they should care above and beyond the normal assumptions that we make, because blowing up a factory that kills thousands of people, even if it's legal, even if it's just neglect and wasn't intentional, is not the right thing to do. Having said all that, we are going to assume in our preferences, in our analysis of this problem, that the principal issue for me as a manager is to maximize shareholder wealth. What else can I presume about you? I'm going to presume you're reasonably smart, that you're reasonably diversified. Presumably you're holding something very close to the overall stock market. And my stock is only a very small piece of your portfolio. I'm going to assume that you want me to compare all these projects that I have, that I could take, relative to all the other projects that you could take by investing in another company. If my projects are better than the ones that other managers in these other companies can take, then I should take them. But if the other managers have better projects with better conditions, I really should be giving the money back to you. You should be giving this to other managers, and everybody, and you would be better off. And remember, in my fiction, I try to do everything that's in your interest. Now, as I just said with the pollution, another thing is, do you want to pay me well? Well, obviously, if you pay me nothing, I'm going to leave. So it's in your interest to pay me something. But how much do you want me to pay? So there's a conflict of interest that you and I also have, that management and shareholders have. And that is a really big conflict of interest. But in the interest of the analysis at the moment, just like pollution, we are ignoring it. Now, I've just told you that what my job is as a manager is to increase the share price on your behalf. Sometimes it's difficult for me to know how to do this. So, should I invest in Bitcoin for you? On one hand, I might say investors like what they like. They like Bitcoin. Well, at the moment, they like Bitcoin. So I don't want to make value judgments about what it is that the financial markets like. Of course, this is a bad pun. Value judgments? What I need to do is I need to figure out what if other potential investments are similar. They cost X dollars. People in the markets love them and are willing to buy them. And I say could deliver the same for X dollars minus $1 instead. So I can deliver the same thing $1 cheaper. Then presumably you, as my investor, would want me to take this project. But what if all these comparables for X dollars are themselves overvalued? Should I still take the project?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, if investors are willing to pay $100 for green coffee right now, and I can deliver green coffee for $90, who am I to know that green coffee is a fad? So they're willing to pay $100, I can get it for $90, they can sell for $100, whatever they have elsewhere, buy mine for $90 and pocket $10. Good for them, good for you. So I should take it even if I believe that green coffee is soon going to be worthless. Take the extreme example. Take Bitcoin. It costs about $100,000 for a number sequence. A Bitcoin is a number sequence. Can you believe this? It's just a set of numbers. Now, in the end, I know they're going to be worthless. But if I can deliver them for $90,000 rather than $100,000, I should take this project, because when I have your money, I buy this with $90,000, and now you own the equivalent of a $100,000 Bitcoin for only $90,000. Now, where in the net present value formula is your own project, and where are your peers' comparable projects?
Please pause this video now, answer the question on a piece of paper, and then continue.
Your project is primarily in the numerator of the present value formula. It's the expected cash flow. The comparables, the peers, are primarily in the denominator. They give you the expected rate of return. That is the investor's opportunity cost of capital. Remember how I just said, they should evaluate our projects relative to that, what other people can do? This is the money that if they can earn higher expected rates of return elsewhere for this type of riskiness, we should just return the money. We shouldn't take the project. Now, the expected rate of return, because I have to match my project, whether it's Bitcoin or a house or something else, because I have to match this, to similar projects in the market, there is a little bit of my project identification in the ER as well. But it's just in order to find out what are the comparable projects to my own kind of cash flows. So what finance wants to deliver, as a corporate manager, it wants to deliver my investors appropriate opportunity cost of capital. That is the thing that is the ER in the present value formula. The expected value of the project numerator, 1 plus ER denominator. The expected value of your own cash flows is always up to you. Finance has no guiding models for this whatsoever. It can only help you with telling you in the overall market what are expected rates of returns for similar projects. That's where our analysis comes in. That's our primary goal. But how do we estimate this matching expected rate of return on similar type projects? How do I find good comparables in the market with particular prices? Well, the price translates into an expected rate of return. We benchmark. For cars, I use cartrader.com or any of 5 other sites. For houses, if I want to benchmark my house, figure out what could I buy a house for elsewhere that looks just like my house, I can use Zillow or Redfin, or I can do a detailed comparable analysis of different houses that have recently sold. For publicly traded companies and projects inside my company, it becomes a little bit more difficult. What's a good comparable? Do I want projects that are in the same industry? Do I want firms that are similarly levered as my firm? Do I want to look at the price and the relative expected rate of return of firms that are as old as my firm? Do I want to adjust or look at firms that have similar growth rate as my firm? What if I want to value a business consisting of 1 house and 1 car? What is the appropriate expected rate of return on the bundle?
Please pause this video now. Answer the question on a piece of paper and then continue.
Well, that's not so hard. I value each separately and then I recombine this. That is, I find the price on the house, I find the price on the car, and I evaluate them appropriately. That should be the equivalent to my business then. So for bundles, a good plan of attack is as follows. I split my rate of return on my car and my house into components, which I'm going to call A and B here, and each component is easier to price. Then I benchmark each of the components separately, and finally I put it all together again with the expected rate of return formula. All I need to figure out is what the pieces A and B and C are. So what matters? Does it matter when we expect our cash flow? Well, probably yes, because I know the Treasury yield curve tells me sometimes investors like long-term instruments more, sometimes they like short-term instruments more, so there's going to be a term premium there. I also know that riskier cash flows usually require higher expected rates of returns. I know that stocks on average had higher expected average rates of returns than bonds. So we've got something called the equity premium here. And we're going to talk about this in a lot of details. Does it matter how my cash flows would add to my investors' overall portfolio risk? Probably yes too. This is probably a premium on stocks that have higher beta, which is things that our investors don't like. So I know these things somehow should be related to what's the appropriate comparable of things that I look at in the publicly traded market when I try to benchmark my own projects for my investors' sake. Now, of course, we don't value projects in an incomplete capital market yet, only in a perfect capital market. But I'm going to give you some speculative benchmarks also for such cases. So if it's an imperfect capital market and some payments are taxed more than others, Then if I want to get my investors to give me money for those more taxed ones, somehow I've got to offer a higher expected rate of return for them because they will have to pay higher taxes on that. Another thing that my investors may like is the ability to sell investments fairly quickly. So if there's another crisis like the Great Recession of 2008 or COVID of 2020, how long will it take them to sell to obtain money for an emergency? They like this. We know they like this. So therefore, if I have an asset that's not easy to liquidate, real estate, that usually has to offer a higher expected rate of return. Also, there is another problem here. What if you, as my investor, don't trust me? So under those circumstances, I may just take your money and abscond to Cuba. How do you know I wouldn't? So if I want you to give me more money, I have to try and assure you that I'm not going to run off with the money. And to the extent that I can't fully insure you, I've got to offer you a higher expected rate of return, or you would basically say, no way, Jose. What can we do? Well, one of the things you've already learned is you can split cash flows into safer and riskier components. Sometimes your firm itself has safer and riskier components. For example, you may own a building and some cryptocurrency operations. While the buildings are fairly safe and not that variable, the crypto operations are very risky and have a high beta. In this case, I can price the building by itself against fairly safe securities and the crypto against something that's much more risky. But even if this is not the case, even if I have a medium risky kind of operation, I could still split the project into debt and equity and thereby manufacture a relatively safe component, which is the debt component, and a relatively risky component, which is the equity component. And then I can take the safe component and try and benchmark it to other corporate debt or other relatively low-risk investments, and I benchmark the equity investment to other stocks or other risky investments. So, pricing corporate assets like debt is usually not difficult at all. It's not that unreliable. They don't vary that much, so we don't have that much uncertainty. Relatively easy to do. The equity component is very difficult to price. The most commonly used benchmarks that are trying to do this rely on the equity premium, also sometimes called the market risk premium. That is the difference between the expected rate of return on the stock market and some measure of a risk-free asset, sometimes bonds, sometimes bills, certainly nothing that can default. It's defined, and I've put the formula at the bottom. Equity premium is the expected rate of return on the market minus a risk-free rate. And the risk-free rate is known, so I don't need to put an expected value on there. And the way I think about the equity premium is it's a normalized way of quoting what the price of risk is, how much extra return you get on average for holding something that is much riskier than something else. Now, forget about our managerial problem for a moment. Let's say you're a retail investor, not a manager. Do you care about the equity premium, that is the difference between the market's expected rate of return and the risk-free rate?
Please pause this video now, answer the question on a piece of paper, and then continue.
Of course you do. These are the most important numbers in finance. The risk-free rate is all about, is it worthwhile to invest or would I rather consume today? So if the risk-free rate is 50%, that says that if I just can control myself and not consume it, I'll have a lot more money next period to actually consume. So I'd rather save, I'd rather invest. That's the second part in the equity premium formula. And the ERM is all about the risk premium. So should I take more risk when I want to save my money today or less risk? So here's the equity premium. Perhaps the most important number in finance, all of finance. Also called the market premium or the risk premium. It's defined as the expected rate of return on the market minus the risk-free rate. It's more stable than the expected rate of return on the market itself, because in some years, like you have high inflation rates, they both shoot up, so the difference sort of cancels out. It plays a central role in a lot of finance. Back on track now. What we want to do is we want to value our project. We want to figure out what is the ERV. We're going to use leverage to split our project into one piece that is safer and one piece that is riskier. We could also, by the way, then divide it further, like into one piece that pays off sooner and one that pays off later, and use the term premium, but we just don't have that much time. So once you understand the principle, you will understand the rest as well. We're going to consider the safer and the riskier pieces of our business separately. We're going to benchmark the safer piece to safer bonds and the riskier piece to riskier investments elsewhere. We know how to do this. We know how to split anything medium risky into something less risky and something more risky. And the end is to end up with components for which we can find good comparables in the market. So here's how we start. We're going to manufacture from a firm a debt claim and an equity claim. The rate of return on my firm is the weighted returns of the debt plus the weighted returns on the equity, even though I call it WEQ here. That's just 1 minus W debt also. And then the expected rate of return on the overall firm is just taking the expectation inside. There you have it. Let's look at the debt piece first. This one is easier to value. Expected yield differences for firms are unlikely to go very far apart. Where would we read off the risk-free rate today?
Please pause this video now, answer the question on a piece of paper, and then continue.
You can get it from the US Treasury website. You can get it from Bloomberg. There are many different sources. We have already done that. Now, our bond is not going to be risk-free, so we should not compare our corporate project debt to US Treasuries. But we can find other corporate bonds which have similar default characteristics, both in terms of premium. This is actually called matrix pricing, where you try and match different characteristics and then spline and interpolate between them. It's not that difficult. You're going to be fairly accurate with this. So you would look at an equivalent corporate bond yield curve instead of a treasury yield curve. When you do that, however, you need to remove the default premium from quoted prices. So this is all going to be net of the default premium. Remember, we're only interested in the expected rate of return, not at the promised rate of return. So you got to remove this both from your own bond and from your peers' bonds. For big corporations, the expected corporate bond rate of return is probably not hugely higher than the rate of return on US Treasuries. Maybe 100 to 200 basis points for long-term debt, maybe 50 to 100 basis points for short-term debt. Now, for small startups and retail investors, it's probably quite a bit higher. But even there, the default premium is a large part of it. So it's not all just what they quote the average rate of return is going to be. Now I'm going to move on to my equity piece. This one is typically a lot harder to value because it's also a lot riskier. We need to start with good benchmarks in the market, for which most people use the equity premium that I just mentioned above before. Now we move on to our equity piece. That one is typically a lot harder to value because it is also a lot riskier. We need to start with good benchmarks in the market. Most people use the equity premium mentioned above for this. So, where could you read off the expected rate of return on the stock market, or for that matter, the expected return on the equity premium?
Please pause this video now, answer the question on a piece of paper, and then continue.
Nowhere. We're all guessing. That's a big problem. So we know that the expected rate of return on the market is determined by the demand and supply, but there is no publication, there is nothing that tells us exactly what it is at the moment. Now, you may guess it's 1%, I may guess it's 3%, somebody else may guess it's 5% per year, and there is nothing that can distinguish who is right and who is wrong. Of course, after the fact we'll find out, but it's not after the fact, it's before the fact at the moment. So all of our expected return that we can do will really be relative to the overall stock market. So if you guess the overall stock market has an expected rate of return of 1% and I expect it to be 5%, we're going to have a different cost of capital also in our corporate projects. That's unavoidable. That's just how it is. So very precise estimates for sure don't exist. Fortunately, if you have mutually exclusive projects, especially if they're all of similar risk, it's not going to matter that much. So if I think one of my projects has a expected rate of return of 20%, another of 18% appropriately, well, in both cases, the 20% is higher than the 18%. So the discount rate that I'm going to assume is not going to change the ordering of the project. I would still take the correct one of those two different projects. In those cases, it's not that important. It is very important when we decide on whether to take a project or not, just in absolute terms, or if I have to choose among projects with very different risks. So because I'm going to then, depending on my equity premium estimate, use very different costs of capital for those projects. Now, you also have to watch out that the equity premium that people are quoting can depend on how you're quoting it. So sometimes if you have a long-term project, like a 20-year project, what you really want is a 20-year geometric equity premium, not individual year multiplied by 20, but compounded over 20 years, and we already know that compounding is different from just averaging. We have to compare apples to apples because in the present value formula, I'm going to have my appropriate cash flow at the numerator and my appropriate expected rate of return on the denominator, and I have to both quote them in the same units. It's more important when you have the present value for a long-term project, which one you're using. So, also, looking backwards in time, when I try and use history as a guidance for what it is that I will want for the future, it depends on how long I look back in history. Should I look back 20 years? Should I look back 50 years? Should I look back 100 years? If everything was stable processes and nothing would ever change in the market and it's all just realizations, then I want to choose the longest period possible because it gives me the most information. On the other hand, if the world has changed significantly from 100 years ago, maybe investors have become more or less risk averse, then what happened 100 years ago is no longer as important for what's happening today. And in that case, I may not want to do this. So here's a graph that gives you an estimate of the various rates of returns on stocks, bonds, bills, and inflation, depending on how long you look back in time. So 50 years looking back in time is often not a bad estimate. And if you look at that in this particular graph here, over 50 years, stocks had an average rate of return of about 10% per year. This is arithmetic. It's a little bit less in geometric terms. If you subtract out what bills, that is short-term interest rates were offering, they were offering about 5% over the same 50 years. So in this case, you would have an equity premium that is about 5% per year. If you quoted your equity premium relative to corporate bonds or government bonds, well, those had a much higher average rate of return. In this case, your equity premium would have only been about 2 or 3% over 50 years. So depending on what you choose as your benchmark period, I could quote you as high a rate as 6, 7, 8%, or as low as just 2 or 3%. Depends what you think especially mattered from between 50 to 100 years ago in terms of what happens today. Which one is the right one? Nobody knows. Nobody knows. We don't know this. Of course, what we really want to know is not what it was in the past either. What we want to know is what will it be in the future? And many people just use 5% without thinking because they use a sample period that corresponds to the main data set in finance, which just happens to be about 80 to 100 years at the moment. But I'm not so convinced that is the right sample frame. For me, it seems more like 50, 60 years seem more reasonable. But there's no particular reason why I know it better than those other people. So it's just, to me, it's personal opinion. There's very little science in here. We have to guess what the equity premium is. There's no way around it, and nobody can do it better. So the arithmetic equity premium versus short-term bonds from 1926 to 2020 was about 8.5%. And depending on whether I start later, like 1970, whether I use long-term bonds or whether I use short-term T-bills or whether I use geometric return, it can go all the way down to about 2.5%. So I can quote you between 8.5% and 2.5%. They're all consistent, they're just different. Again, these are just historical, not necessarily forward-looking, although that is what I really want. Now, is there a term premium for equity? We know that there's a term premium for bonds. We know that long-term bonds offer a higher average rate of return than short-term bonds. For equity, the answer is not clear. There is some research on that, and some people disagree. For the most part, we just assume that the equity premium is about the same over the short horizon and the long horizon. But other people may come up with answers. Yes, there's a difference, a term premium, an extra term premium of another 1 or 2%. Here's another big problem. How do we think about rare shocks? Was the historical equity premium so high because we just got lucky? We had COVID, we had the financial crisis, we had the Great Depression, we had the Great Recession, we had all sorts of different things. But frankly, we never had a period like, say, Germany, where the whole stock market disappeared. And we never had a true epidemic like smallpox, which wiped out 30% of the population of Europe a few hundred years ago. If that were to happen, the stock market could do something completely different. How do I estimate that? I really don't have great data. And this is a really important problem, both in academia and in practice. So in academia, this is called the peso problem, which is sort of a weird name. The name comes from the fact that we always saw a weird exchange rate that never corrected. And the answer to this is probably that people expected something to happen, which just never happened. And a related subject area, more in practice, these were best-selling books, is called the theory of the black swan. How do we interpret when something really unusual shows up? And they're all interlinked problems, and they're all really, really difficult to estimate. And we really don't know how to do this. We do know, however, that of the equity premium, it can explain at most 1 to 2% of the historical equity premium. How do I know this? I can be very fancy with something called index options, which would have allowed me to insure against the peso problem. To back this out, we're not going to do this in this class. Now, what about the future? Could a high historical equity premium be indicative of a lower rather than a higher future equity premium? Think about that for a moment.
Please pause this video now, answer the question on a piece of paper, and then continue.
Possibly. For example, consider this scenario. Let's say that investors became less and less risk-averse over time. So a very, very long time ago, for them to invest required a very high equity premium. And then they became less risk-averse, so they were willing to buy stocks at a much higher price because they didn't require as much expected rate of return. So if I looked over the last 100 years, I might have seen investors becoming less and less and less and less risk-averse. That would have meant that the price of stocks went up and up and up and up, but it went up because our future expected rates of return at this time are now much smaller than they've ever been. and they have become smaller in the past as well. Do I know that this is not the case? No, but it's exactly the opposite of what we do when we use historical equity premium as our stand-in for future equity premium. Wouldn't it be nice if we could use some other variables to predict the time-varying equity premium? So, for example, there are some periods in which the dividend yield is very high and some where the dividend yield is very low. Can we use it? Well, theoretically, you would think that if I have a very high dividend yield, say 10, 20% per year, well, that should mean, presumably, I'm getting very high expected rates of return here. Otherwise, something wouldn't seem right. And people have run regressions, me too, in my academic research. And it turns out this theory, even though it sounds great, doesn't work at all. So if you look historically at dividend price ratio and see whether you can predict how the stock market is going to do the following year or the following month or the following 5 years, it doesn't work. There's no predictive power there whatsoever. So great idea, would be lovely if we could do it, would allow us to time the market. Heck, I would put my own investment money into the market only when the dividend price ratio was high and not when it was low. But empirically, this just hasn't worked. Now, another way to estimate what the equity premium could be would be to see what would it take to get investors into the stock market rather than the bond market or the bill market. The bill market is, of course, the cash market, very short-term things. And I'm going to assume that there's no gifted horses here. That is, nobody is willing to give you 30% per year. That would seem completely unreasonable. So I would think that given what it takes to pull me into the stock market, it's way less than 30%. So based on these arguments, in the long term, what would it take to get investors to put their money long-term into stocks rather than bonds? We're looking at numbers of 1 to 2% per year. That really makes you end up quite nicely 20 years later when you retire. 3% would already mean that you end up with twice as much money for an investment over 25 years compared to bonds or bills. That's a lot of money when you think about it. So twice as much money. You can defend that. 3% people that are much more willing to take risks end up with twice as much money. It's fine. 6% seems far too high forward-looking, meaning that you would end up with 6, 7, 8 times as much money after 25 years when you retire than when you hold treasuries. It just seems absurd. Now, it is true that in the past, people who did this did end up 6, 7, 8 times as wealthy as people that were more risk averse and just put their money into treasury bills or treasury bonds. It's just that forward looking, it doesn't seem right. Now, we also did something called the implied cost of capital earlier, and that gave us numbers of 2 to 3% also. So that just seems much more comfortable given where we are at the moment, price level, dividends, although I've just told you that it's very hard to predict with a dividend ratio what the stock market is going to hold. In fact, we couldn't do that. Nevertheless, it all seems to sort of suggest we're looking at 2 to 3%. What about if we just ask the experts? What do the experts believe? It's a little bit like the blind leading the blind, because where do they get their opinions from? It's not like they know more than I do. They haven't studied this better. But if you take a look at this, you ask people in the year 2000, that was just after the first internet tech boom, and you ask them, how much do you think the stock market is going to outperform bonds and bills over the next few years? And they told you 15% per year. I mean, just an absurdly large amount. If it was really that large, why would anybody not put their money into stocks? These numbers seem to be more like 10% these days, but still incredibly high, far too high to be believable. If you look at McKinsey, which does corporate consulting, they usually advise their clients to use numbers like 5%, which is still fairly high. You look at the Social Security Administration, they need to estimate an equity premium to have an idea how much they have to pay out if they put their money into the stock market. they use a number of about 4%. Now it seems sort of reasonable. CalPERS, which is the big retirement fund for California, 5%, 7% for the stock market. Maybe that's come down now. We don't know yet. They change this around every once in a while. When you ask professors of finance over the last few years, they give you numbers like 4% to 5%. Me, I am much more pessimistic. I think it's more like 2%, 3%. But, I've told my students the same thing for the last 10 years, and I didn't do well. The people that actually put their money in the stock market did far better than I expected. Hey, if you had asked me, I'm going to tell you there's going to be a global epidemic out there. A global epidemic, it's going to shut down the whole economy, which happened in 2020. What do you think the stock market is? I would have said, oh my God, I would presume maybe it's 0 to 1%, much less. And instead it was like 8 to 10%. It was just complete error. It's very, very difficult to predict the stock market. If you look at what textbook authors have recommended over the decades, although I wish I could update this to the latest one, I don't have that, the equity premium estimate has been going down year by year by year by year. So textbook authors like me, as you're reading my textbook, have become more pessimistic when it comes to the equity premium. Let me take CalPERS, for example. So they have decided to have a geometric market premium of 7% in 2019. This seems unrealistic to you, to me too. But if they had lowered this estimate, California would have been forced to set aside more money for their pension fund obligations. And that would have to be done today. Now, politicians prefer to leave the estimates as optimistic as 7%. My God, we're going to earn a huge amount of money in the future, and just kick the can down the line to their successors. If you think about this, they have about $500 billion in investment, and 0.25% is about $1 billion. And guess what? There are hordes of people that are coming in that are equity premium consultants that say, I have deep knowledge of this. It should be 6, 7, 8%. And of course, the higher the number is, the more likely you're going to be hired as a consultant, because this is what the politicians want to hear. This is the implied cost of capital, which we've done before with perpetuities. That gave us a number of about 2% rather than 4 to 6%. But again, it's been wrong for decades, and it's still like this. We also believe, for the most part, that the equity premium should be fairly stable. It shouldn't jump around all the time. What should be sort of stable is how risk-averse investors are. But when you look at them and you ask them, how risk-averse are you, it's very strange, because for a year or two, they seem to have no concern about risk whatsoever. And they tell you, oh, we don't care. And then a recession hits, and all of a sudden they go, oh my God, I cannot take any risk. That is not rational behavior. But apparently a good number of investors are doing this. So they give you equity premium forecast, which also then depends on the forecasting interval. So they may say something like, well, I think in the long run, the market may earn about 5% per year over the next 30 years, but right now the market is overvalued. Really? The market is overvalued? You know that the market is overvalued? I've studied it for 40 years. It's an extremely competitive market. There's BlackRock, there's Goldman Sachs, there are all these experts, and you have a better idea than the market whether the market is overvalued or undervalued. Fantastic. Now, if you really had this ability, of course, you would be a genius. You would be infinitely rich, or not infinitely, but hugely rich. The fact is incredibly difficult to predict the stock market. So, which equity premium is right? Is it 1%, 3%, 6% per year? We don't know. No one knows. Be reasonable. So don't use numbers like -5% or even 0%, you should expect some sort of a premium for stocks. And don't use numbers like 10 to 20%. So be reasonable. Also be consistent. That is, don't have one project valued with an equity premium of 1% and another one with an equity premium of 6%, because then you're just making up numbers. So pick a number, try to stick to it, and then pray a lot. Pray a lot that you have the right number. Back on track now. Okay, so we still want to get the expected rate of return on your firm in the present value formula, where I have the expected cash flow of our firm in the numerator. And remember, that's based on all the things about our own firm, where me as a finance person can give you very little advice. And it should be divided by 1 plus the expected rate of return that is similar to our comparables. That is your opportunity cost of capital, the things that the investors could put their money in. And our plan of attack was to decompose this into 2 pieces, one that is safer and one that is riskier. Now, we can assess each of these pieces individually. We can assess the cost of capital on the debt, easier, the cost of capital on the equity, harder. If our project is sort of medium risky, what we can do is use debt and equity to split our own projects into low risk and high risk components. And we're going to ignore the term dimension. When you actually work with this in the real world, what you want to do is for longer term cash flows, when you use your ER formula, you want to use the equivalent treasury interest rates, which are of course higher usually, not always, usually higher for long-term debt. You have to be careful though. Of course, your expected rate of return on the debt must be the expected yield, not the quoted yield from comparables. So for example, if you are a triple B rated bonds and you see that the triple rated B bond portfolio promises a yield of 6%, it's not going to deliver that yield of 6%. So all in the formula, the expected rate of return on the debt, you must take out the default premium. So that would be, I don't know, rather than 6%, about 5%. So make sure to not work with promised expected rates of return on the debt, but with expected rates of return on debt. Similarly, the expected rate of return on the equity has to be the expected rate of return. Of course, when we do things in the stock market, like the equity premium, the expected rate of return on stocks is expected. Very few people will tell you a promised rate of return on stocks. And of course, in the present value formula, your own expected cash flow must have been default adjusted too. So you can plug in whatever is the expected cash flows in the best outcome, but whatever the expected cash flow is unconditional. Now, because firms can value weight their debt and equity cost of capital, it becomes very easy. You may have a cost of capital similar to debt used in your project, say 5%. Perhaps 6% quoted on the comparables, but 5% is the expected rate of return. You've got an equity premium estimate of, say, 4%. So your cost of capital for the equity component is about 9%. And if your project is 80% debt and 20% equity, all you need to do is 80% times 5%, cost of capital on the debt, plus 20% times 9%. So you would use a cost of capital on your project of about 6%. Do not imagine this to be an accurate estimate. We do not have that kind of level of accuracy to say it's 6% plus or minus 0.2%. Truly speaking, those are more numbers between 4 and 8%, maybe 5 to 7%, depends on the kind of projects that you do, but it's very, very rarely accurate. So no one in this world can give you an accurate estimate of appropriate expected rates of returns on stocks and risky stock-like projects, and therefore the cost of capital on your projects. This does not exist. The theory assumes we know all of these things, but in real life we don't. We just have to assess them reasonably. And if you are better than others, that is, if you can estimate when the rate of return on stocks is higher and when it's lower, don't even bother with any of this stuff. Just start a fund that does market timing, where you buy the market when the expected rate of return is high, and you don't buy the market when the expected rate of return is low. I am starting you off as far as science, finance is a science, a social science, as far as science has gotten us. And from here on out, if you can do it better than how far general science has gotten us, you will be rich. And in that case, of course, you can boast that you've taken my class. Now, here's another lovely thing about this. Because we may have different costs of capital across different subsidiaries. For example, imagine that you are General Motors, which manufactures cars, but you also are a financing company. So when customers come into your showroom, they will want to get a car loan. So you really are consisting of two firms. One is a car manufacturer, one is a car financing companies, and they may well have different costs of capital. So what you need to do is you need to use the individual cost of capital on the manufacturer and on the financing company, and then you can just weight those and average them out just the same way we've done the other ones. Same thing if you are a hedge fund and you have some US treasuries and you have some equity call options, your overall cost of capital is the weighted cost of capital on the comparables. It's not just the one on the equity call options. Now, let's do the following. If you want to price a condominium in Santa Monica, which risk-free rate and equity premium should you use?
Please pause this video now, answer the question on a piece of paper, and then continue.
Stop right here. Don't be stupid. Look, first use common sense. Use the appropriate tools. I know I've given you formulas and they look like hammers, and whenever you see a nail, you use your hammer and you try to whack the nail. But please don't do this. Think about what the best benchmarks are. If you want to price a condominium in Santa Monica, you should not use any of the benchmarking against the stock market. What you really should do is you should benchmark against other condominiums. So pricing a condominium, do not look into the stock market. Look at comparables in Santa Monica, other condominiums. That's it for this video, for Chapter 9, and for the subject of benchmarking. In the next chapter, we move on to the most prominent model of finance, the capital asset pricing model. See you soon. Bis bald.
Sorry, I'm a bad passenger. Please drive carefully.
Don't worry. Whenever I'm driving, I think about the fact that people only value things when they don't have them.
What are you talking about? Health? Money? Sex?
No, silly. I'm talking about brakes.